Greetings and welcome once again to another session on the Dr. Kareem Ainsley Encounter. In today's setting, we're going to be discussing that of net worth and debt to income ratio. Yes, net worth. Many people always wonder, what is my net worth? But if you don't know your numbers, then you will not be able to calculate your net worth. Your network is pivotal to know so you can assess if you are improving or if your riches and wealth is currently under erosion or has eroded to a place in which you have to file for bankruptcy. And debt to income ratio is important so we can assess the state that you're in comparison with your debt and your income. If that is something that you are interested in understanding a little bit about, then meet us on the inside. Thank you for meeting us on the inside. Let us now move into the meat of the matter which you came to devour. Network. When we speak of network, what we're speaking about is the total value of all your assets minus your liabilities. And for that reason, we had indicated to you what were assets and what were liabilities in a previous video. And if you'd like to watch that video, the link will be right above and in the description below. So your network gives you an idea as to your financial health. Yes, you're not only healthy physically and emotionally, you're also healthy financially. So you need to decide if financial health is something that you are interested in. Your network is a measure of the person's current financial health, yes, but also their financial position. What kind of position are you in? Are you in a good position or are you in a bad position? That is a question I want you to be able to answer. You see, your network represents the value of all your assets that an individual has, or if you're a company, then the company possesses minus all its liability. So why are we saying company? Because you are being positioned how to formulate a company, and you are also being positioned how to assess a company to see if it is a worthwhile investment. And as such, we'll get more into the meat of the matter. So yes, for an individual, net worth is calculated by adding up all their assets, such as their cash, their investment, and subtracting all their liabilities, such as their credit card debt, their student loan debt, their mortgage debt, and whatever other debt they may possess. So all of that will have to be subtracted. A free guide to this network calculation can help you to determine your assets and your liability, which is available using the link in the description. While you are there, please don't hesitate to sign up for our newsletter so you can get access to our exclusive content that will guide you on your financial journey. And always remember, every information that we present here is absolutely free. Now, as we look at network and we assess it based on a company's perspective, a network is also known as the shareholders' equity or the owner's equity. And this is calculated in the similar manner. It's calculated by adding up all the company's assets, such as their cash, their investment, whatever it is that they own. And then we're going to subtract it all from their liabilities, such as their loans and their accounts payable. The resulting number will represent the net worth of the company and represent the value that would be left over for the shareholders if the company were to be liquidated and all its assets were sold off just to pay debt. And when companies go into bankruptcy, the thing that you need to understand is that the stakeholders are given preferential treatment. So those persons who the company owes money, they are paid first. Whatever is left after that payment is done, the shareholders' equity or the owner's equity, then that there will be paid over to the shareholders. So if you have a common stock in a company, after liquidation has been done, that is the only time you'll see a penny of your money. So you have to understand why I always advise never invest all that you have in any company, especially when you are not the one in charge and controlling the company. People will tend to present information at times that are not true, and people can manipulate numbers, let them say things that are not accurate. So you can only invest wholly in yourself and your company. And if you are not willing to invest totally in yourself, then there's no need to invest in any other company. Now, let us get back into the meat of the matter. So, network is an important financial metrics because it provides a snapshot of an individual or a company's financial position at a given point in time. So, this here can change from time to time, because based on where the assets are located, if they're in a stock market, if they're in the cryptocurrency market, if they're in foreign exchange market, as those assets fluctuate, your net worth is also going to fluctuate based on those asset values. And the liabilities too also tend to fluctuate if the person is taking on more debt, if the person is paying down the debt. So that there needs to be considered, and depending as well on the interest rate. So it can be used to assess the financial health of a company or to set financial goals for an individual. And if you're an individual, you want to know where you are so you can determine where you need to be and the steps and measures that are needed to be taken in order to reach there. And from a company's perspective, I am giving you the concepts so as you can assess a financial statement. You can read a balance sheet and understand exactly what it is saying. So that's when we go into assessing companies to determine if they are a good fit for our investment time horizon, then we can deduce from that. So the formula, because I know that a lot of you like formula, a lot of you are mathematicians, or you just like to be a little bit above the average. So a network is simple formula. You don't need to go to college to understand this. It's just the total assets minus your total liabilities, and then what you get, that's the net worth. So to calculate it, you need to first identify all the assets that a person has, or if you're a company, then the company possesses, including the cash and the cash equivalent, investments in real estate, equipment, intellectual properties, inventories, account receivable, and deferred taxes, among other assets that are there that we have not mentioned. Then you're going to add them all up, and then this is going to give you the total asset. So that there would be the total asset. Now, the next thing we're going to have to do is to identify all the liability that a person or a company possesses, including the accounts payable, those are accounts that need to be paid, the loans that they have outstanding, the tax liabilities, the taxes that they owe, the wages that they need to pay to the staff, the salaries, the rent, the lease agreement, the interest payable, the deferred taxes, and pension, whatever it is, the post-employment benefits. We had to add up all of those, and after that is done, then we can get the number which gives us our total liability. So now that we have our total asset and our total liability, all we're going to do to get the net worth is to have the total asset minus the total liability, and the final number will give us the net worth. Let us go over an example. If a company has a total asset of $1,000 and a total liability of $50,000, its net worth is calculated by 100,000 minus the 50,000, which is equal to a positive net worth of $50,000. This means that the company shareholder equity is $50,000, and this would be equivalent to the book value. It is important to note that net worth can fluctuate over time due to the change in the value of the assets and the liabilities. So when companies are restructuring and changing their protocol, then this can affect the net worth of the company. Therefore, it is very important to do regular checks and recalculation of the net worth to get an accurate picture of a person or a company's financial position. And this is very important because people change, companies change, management change, structures change, and the companies may tend to deviate from their core principles. So it is okay to change your investment and your investment strategy. So let us look at an individual network. Say, for instance, when you add up all your network, you have 1 million, and when you check all your liabilities, you have maybe 100,000 in liabilities. Then you will have a network of 1 million minus 100,000, which will leave you with positive $900,000 in net worth. And the net worth can be calculated in different ways, but this is the way that we're going to be using at this time until we have built on this substantially, so that we can understand the different areas and different methodologies of calculating the net worth. The next thing that we want to examine is the debt to income ratio. This is basically the percentage of your monthly income that goes towards paying off debt. All right, a low debt to income ratio may be considered desirable because it indicates that you have a relatively low level of debt in relation to your income. So banks and loan offering institution would like this in order to extend the courtesy of a loan. The debt to income ratio, or the DTI, is a financial metric as well that comprises a person's monthly debt payment to their monthly gross income. It is used to assess a person's ability to manage their debt and is an important factor in determining their credit worthiness. And we're going to be looking at what the word credit worthiness means when we move down into discussing all things credit. But for now, the DTI ratio is calculated by simple ratio, debt to income ratio. In the name, it gives us what is happening. Ratio, there's going to be a divide, right? So the DTI is calculated by dividing a person's total monthly debt payment by their gross monthly income. So all the money that they make before taxes, that there is the gross income, and then the debt will be above it. For example, the total monthly debt payment for a particular individual is $1,000, and the gross monthly income, that is before tax, is $4,000. Their DTI would be 1,000, the debt is above, and the monthly income is below, which is 4,000. So that is 1,000 over 4,000. That is 1/4. So that there would give us a quarter, and quarter is about 25%. Exactly 25%. Beautiful. So that is how we can compute the debt to income ratio. The debt to income ratio are generally expressed as a percentage because it's a ratio, and 100% would be 1. And they are used by lenders to assess a person's ability to manage their debt. Yes, we currently live in a debt-based society in which we have access to a lot of debt. If debt stops, then the whole system of the scheme that has been created will collapse, and we don't want that. So we have to continue this debt cycle for now until we have a better measure of managing and monitoring our wealth and finances. So lenders generally prefer to see a DTI ratio of 36 or lower. Yes, so that means that 36% of your income, your gross income, can go towards paying off debt. However, the lower it is, the better it is for you, because it means that you have more cash flow and they will be more prone to give you money. You have to realize that the more money you have, the more money finds you. When you need money, it is hard to find money finding you. So you have to understand how the money system works, because everybody sees you as a good candidate. Everybody wants to give you money because they can guarantee that they will be making a return on their investment and it is safer in your hands. So when this is done, you will be extended the courtesy of different lines of credit, different loan facilities, but you have to decide which is best for you. And when this is observed as well, you can also negotiate your rates. Now, a high DTI ratio may indicate that a person is overextending themselves financially and may have difficulty making their debt payment. This makes it more difficult for them to get approved for loans or credit card, or they may even get less favorable loan terms. So this is going to also be based on your credit score, credit evaluation as well. So if your debt to income ratio is very high, this is where the predators come in and they say, well, you are unreliable or allegedly unreliable individual. So I am not going to charge you the market rate of 7%. I am going to charge you 50%. And because you're in a bind and you're in a compromised state, guess what's going to happen? You're going to want to take that 50% because that is the best that you can do under those circumstances. So your credit and credit worthiness are critical, and how you can maintain that and manage that is first understanding your numbers, your income, your expenses, and maintain and regulate your DTI, your debt to income ratio. On the other hand, a lower DTI, debt to income ratio, may indicate that the person has a good handling on their debt and is a responsible borrower. So everybody wants to lend money to this person. This can make it easier for you to get approved for loans and credit cards, and they have more favorable offers. So the market rate is 7%, but because you are a good person based on your debt to income ratio, then you may even get it at a 5%. It is important to manage this debt to income ratio carefully, as it can have a significant impact on your financial health and ability to borrow money. I want you to be in a position where you can go to any bank and borrow as much money as you desire. But first, you have to get your finances in order. So let's just go into a simple methodology of calculating the debt to income ratio. To calculate debt to income ratio, you need to gather all the information about your monthly debt payment and your gross monthly income. Here are the steps that you can follow. First, calculate the total monthly debt payment. Add up all your monthly debt payment, including your mortgage, your rent, if you have a rent, your car loan payment, your credit card payment, your student loan payment, and any other debts that you have. Then you're going to calculate your gross monthly income. If you have 10 different streams of income, you calculate all of those. This includes any amount of money you earn each month before taxes are deducted from it. This includes your salaries, your wages, your commission, your bonus, and any other income that you earn on a regular basis. Then you're going to divide your total monthly debt payment by your gross monthly income. Once you have these numbers divided, your total monthly debt payment by your gross monthly income, this will give you your DTI ratio as a decimal. And then just to convert that decimal, we don't need to do complicated maths. All we're going to be doing is just multiplying whatever it is that we get by 100. So if you got a DTI ratio of 0.3, then you're just going to multiply it by 100, and then that is going to carry it up to 30%. So your DTI would be 30%, which is not excellent, but good enough to be able to receive different loan offers. Say that you have $1,000 in debt payment. Your gross monthly income is $5,000. Your DTI ratio would be 1,000 over the 5,000, which is equal to 0.2. So in order to calculate that now into the percentage, we're going to just multiply that by 100, so that's we get the percentage, which would be 20%. So 1 over 5, 1/5, 20%. So in this example, we are seeing that the DTI of 20% exists, which means that the monthly debt payment of this individual would be equal to 20% of their gross monthly income. So basically, it tells how much of your income is going towards debt payment. It is important to keep in mind that the DTI ratio can vary depending on lenders and the type of loan that you are seeking. Because if you're seeking a housing loan, sometimes they allow for up to 50% DTI, but that there is a special class of loan. But you have to be very mindful to keep your expenses as low as possible and try to increase your income as best as possible. And there are two ways that you can increase your income. Either you get additional source of income, or you're going to have to change the position that you are in if not able to get increases or raise. So this is where we're going to pause this segment on the Dr. Kareem Ainsley encounter, where we discuss the debt to income ratio, the DTI, and we compared it with the net worth. So now we have a grasp and concept of how to calculate our net worth, which is our total assets minus our total liability. And then we know as well how to calculate our debt to income ratio, which is calculating our total monthly debt payment, and then we're divided by our gross income, and that gives us our DTI. Thanks for spending some time with us here in this space where we use cents to make dollars. Have yourself a money-filled day. Do the right thing, and don't get caught with your pants down engaging in financial. Until next time, be blessed.